Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Saturday everybody. Today is the first day of China's week-long National Day celebrations. Let's start today's episode with the economy. Indeed, most of today's video will be on the economy. And first up, yesterday, Friday, Caixin Inside Group published its Caixin China General Manufacturing Purchasing Managers Index, PMI, which claims to give an independent snapshot of China's manufacturing sector. According to the index, activity in China's manufacturing sector contracted for the second month in September with a 48.1, down from 49.5 the previous month. We remember that a reading below 50 indicates a contraction in activity, while a number above that signals an expansion. Wang Zhe, a senior economist with the group, explains with the report, quote, "Since September, there have been COVID outbreaks in many regions, with the number of confirmed cases shooting up in some key areas compared with the previous month. Demand in the manufacturing industry has been under pressure, while economic recovery has stood on shaky ground." End quote. In a piece accompanying the PMI data, Caixin writes that the drop in household demand prompted manufacturers to cut back on purchases and employment, leading both purchasing activity and staffing levels to fall at a faster clip in September. Some surveyed companies complained too of disrupted logistics. Next up for the economy, the onshore Yuan is on track for a 7th month of losses, and as China enters its week-long holiday for National Day celebrations, analysts warn that worse could be on the way for the currency. With mainland markets closed, Beijing cannot guide investor expectations with its daily reference rate, making the overseas yuan more vulnerable to a dollar change or surge. Quote, "China's central bank appears to be girding itself for any disorderly trading next week. The People's Bank of China set the fixing at a stronger than expected level for the 27th day, the longest run of stronger fixings on record." End quote. But, as we have discussed, the People's Bank of China cannot do much to control the US dollar. Quote, "The People's Bank of China is trying to bring some stability to the market, but the problem is that the dollar is too strong. If the US data remains strong, there is not much central banks can do to stop the dollar rally." End quote. The People's Bank of China is trying to prevent a rush of capital flight while also ensuring that exports remain competitive against other currencies, a difficult balancing trick. Meanwhile, in an exclusive piece citing unnamed sources, UK-based Reuters reports that overseas Chinese state banks, including those based in Hong Kong, New York and London, have been told to, quote, "review their holdings of the offshore yuan and ensure US dollar reserves are ready to be deployed." End quote. Reuters writes that the simultaneous selling of dollars and buying of yuan could put a floor under the Chinese currency, which has lost more than 11% to the dollar so far this year, and looks set for the biggest annual loss against the US dollar since 1994, when China unified its official and market rates. One unnamed source cited by the publication expressed, quote, "The scale of this round of dollar selling to defend the weakening yuan will be rather big." End quote. Next up, and finally for the economy, this week, Hong Kong-listed China stocks plunged to their lowest level on record. Hey guys, if you're enjoying what I'm trying to do here with China Update and you'd like to help me keep the channel sustainable, Patreon and Buy Me a Coffee links are in the description below. If you're enjoying this particular episode, don't forget to hit the like button. It's also a huge help. As always, thank you so much everybody for the ongoing support. In September, the Hang Seng China Enterprises Index declined 14%, representing one of the worst performing major equity benchmarks that month. Now trading at 0.6 times book value, it's the cheapest it's ever been too. Unsurprisingly, property developers have led the drop in the 50-member gauge. Technology companies like Bilibili Inc. have also performed badly, losing over 60% of value in the year to date. The housing crisis, zero COVID, Taiwan Strait tensions, worsening US-China relations, Ukraine war fallout, and the general global rout as central banks hike rates have all formed a toxic cocktail, dragging down Chinese equities in the special administrative region. Quote, Until China relaxes its COVID-0 policy, it is difficult to see what other factor could meaningfully give a boost to investor sentiment, especially in Asia." End quote. Will China open up after the 20th Party Congress like many hope? Well, it's hard to say, and international banks are not holding their breaths. For example, this week, Morgan Stanley told clients that China is unlikely to ease restrictions until at least next year, probably in the spring. In a recent note, the US bank expressed, quote, "Pressure to reopen will build because the zero-COVID strategy has led to significantly weaker income growth and a sharp rise in youth unemployment, outcomes that are at odds with President Xi Jinping's policy goal of common prosperity." End quote. Nomura Holdings has predicted March, and last week, Goldman Sachs said that we will likely not see any reopening before the second quarter of 2023. It's no wonder investors have little appetite then for Chinese equities at the moment, though perhaps most concerning, if recent reporting by Chinese financial outlet Caixin is accurate, is that some Chinese regulators themselves appear just as bearish as international investors. Quote, "Several factors that drove China's growth in the past, such as globalization, technology imports, the demographic dividend, as well as large-scale infrastructure and real estate investment, have almost all undergone fundamental changes. These used to be tailwinds to growth, but now they seem to be turning into headwinds." End quote. And last up for today's episode, a long-ignored region in terms of great power competition, the South Pacific is increasingly being recognized by Washington as a theater for geopolitical competition with the People's Republic of China. We have been following China's actions in the region for the last few years on China Update, with the most notable recent developments related to the Solomon Islands. Now, the United States, working with Australia, is becoming more involved in the region. This week, the White House hosted its first Pacific Island Summit, with 14 Pacific Island nations attending. Analysts agree that this summit is a direct response to Washington's concerns for Chinese inroads in the Pacific. During the event, US President Joe Biden expressed, quote, "A great deal of history of our world is going to be written in the Indo-Pacific over the coming years and decades, and the Pacific Islands are a critical voice in shaping that future." End quote. Showcasing that the Chinese aren't the only ones who can write checks, the US also announced an $800 million package, a, quote, "new milestone in US-Pacific cooperation," end quote, which is intended, according to the White House, to, quote, "strengthen our partnership with your countries," end quote. The package was well received, it appears. During the Wednesday event, all of the visiting leaders, including Solomon Islands Prime Minister Sogavare, endorsed an 11-point statement of vision committing to joint endeavors. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. Have a wonderful weekend, and I will see you all on Monday.